Hi, Pete. So
Hello,
let me
Don.
do this. I'm going to share a screen here, I believe. Doesn't seem to want to let me. There we go. I'm going to do this. Okay. Good morning. My name is Don Vivrette. This is Financial and Estate Literacy. It's your estate. This is spring 2022. This is week 5, Charitable Giving Opportunities. And please don't be scared off by the fact that it says charitable giving, because one of the important parts to us is it's very nice to give, but what do I get from it other than a warm, fuzzy, and good feeling about doing this? It's still what there are certain tax advantages and other things that come up. So, Pete, who are you?
I am the founder and of Financial and Estate Literacy. And our mission is to educate people on money, estate, and charitable planning. And honestly believe that it's good to give. But people have a lack of understanding how best to give, what opportunities there are. And it's kind of a brain press when you think that giving away something that you actually can get something in return. And so the program is called Charitable Opportunities. And David is with—
Not yet.
Oh, not yet?
Not
Okay.
yet. First, what I want to do is I want us to go to the website so people can see it going through and getting information. Just to make sure that pops up. Yes, it does. Okay. So if any of the material or any things that we're talking about when you go into the website, you can click on workshops. We did this one time and it died on us. Estates. And if I come down here to charitable opportunities, it takes us to today's material. So David's presentation that he's going to have in a minute, there's a biography or the biography for David and a series of articles that are available. If I scroll down slightly more and go to previous, for instance, there's last week's presentation. And because if I remember correctly, no, wrong week. I'm sorry, I meant the wrong one. Anyway, so that's where you go look for the videos. They're in the same place. The workbooks are there. If it's not in this week, it was certainly in last week's. And you can go through and take a look at those and utilize those to the extent possible. So therefore, that's what I wanted to do. And I am incidentally the philanthropic advisor to financial and estate literacy, because I've done a whole lot of charitable stuff and researched a whole bunch about it. And Pete said, talk about it occasionally. So I may pop in a bit on and off with David as he's presenting. We have done this together in the past at times. And so we will talk about that. But I'm going to monitor the Q&A, and I am going to provide answers if I can along the way, or I'll interrupt Pete and David and do it that way. So I will be back another time.
Let me say a couple of words about
Please.
you, Don.
Okay.
Besides the fact that you are the voice of God and highly competent in answering the Q&A. Don and I were traveling together, and he came across, we were talking about him selling his business and a building. And I casually just kind of mentioned and says, have you done any crunching of the numbers as to looking at a charitable trust? And he took me up on it and did a bunch of number crunching, became a credentialed crescendo user. He's now, besides having a friend, a philanthropist, a CPA, and he does all this wonderful stuff for financial and estate literacy, literally at no charge. And I don't even have to give him any wine or anything. So I just want to publicly thank you, Don, for all your work. I really appreciate it.
And if anybody, because we've had a lot of people who've attended these and say, well, what if I did this or what if I did that? Happy to help in any way that we can. We can do scenarios using Crescendo, the software that's there. Yeah. David has the same software. In fact, David's organization was the one who ran the scenario for me when we originally sold our building. So
yeah, we all kind of work together.
Yes. I'm going to go away and you can have.
And here we are. Our website is, it's Financial and Estate Literacy. But if you want to get to our website easily, it's IYME.org. David, why don't you come online? Hi, David. Good morning.
Hello, how you doing, Pete? Good to see you.
Doing great. You're going to be presenting the Charitable Opportunities because you are the man to see for Chapman University.
That's correct. So the presentation I'm going to give, the information I'm sharing is applicable to all charities, but I work at Chapman University. I'm the assistant vice president for legacy planning here at the university. So I do planned gifts and major gifts for the university.
What kind of technical or background do you have, or would you, if you were to talk to somebody about charitable opportunities, what should a person look for?
Well, so you definitely want to have somebody that has experience and background working in charitable giving, a knowledge of just kind of the core basic elements of giving. But if you're talking about anything that's involving an estate gift, you probably want to go to, and you're talking with a charitable organization, you probably want to talk to their planned giving officer or someone along those lines that really has the expert or additional literacy in that area. Like for instance, I did a program through the American Council on charitable giving. I'm sorry, my brain is just lost the name of the. But anyway, it's a program that they run, which is a certified specialist in planned giving. I went through that program, took all the tests and did the papers and those types of things. And that's a year-long program that goes in depth into all of these areas. And so that's one of several ways that people can really learn this.
And again, there's no charge or obligation. If you run some numbers for someone, there's no charge or obligation that they have to give to Chapman, although it would be nice, right?
Oh, sure. Yeah. No, the nice thing when you're talking with a charity is that the charity can run a scenario for you to show you what something looks like without obligation. There's no fees that are involved. If they're trying to charge you a fee, you need to find a different charity.
Exactly. Or even if they try to pressure you to make a gift, you go to another charity. There's a lot of good charities around, a lot of good people like David around, but you want to have somebody who has the experience. What kind of software do you use to run your numbers, David?
Yeah, so we use a program called Crescendo, and we use their product called Crest Pro, and it's one of several. There's also a PG Calc, Planned Giving Calculator, PG Calc, which is popular. A lot of charities either use Crescendo or PG Calc. Those are the kind of the two biggies that are out there, and attorneys and other financial planners often use that software as well.
Right. But like David said, a lot of advisors aren't familiar with some of these techniques. Why is that?
Yeah, well, so there's a couple different reasons, and really it has to do with, matter of fact, when we start this presentation, you'll see it's called, Charitable Opportunities, but then it's subtitled, the secrets your advisors never tell you. And there's really two reasons why. I think there's a number of reasons, right? One is that they're oftentimes just not familiar in the first place because they don't specialize in charitable giving. So, they've maybe heard some concepts, but they haven't really learned it and they don't feel confident in that area talking in depth. Secondly, is that, if you're talking with your financial advisor is there to manage your assets for you. They're not really there to help you give away your assets because that's less assets that they get to manage. So, that definitely comes into play, I think.
A little bit of a conflict sometimes.
Yeah. And then third part to that is that if you are working with a financial advisor that gets any sort of commission, then they don't get any commission on you setting up a charitable gift annuity or a charitable remainder trust or those types of things. So those are just some of the reasons why your advisors either one, don't tell you about these things, or two, don't know about them.
Yeah, the outline is on the website, but let's pull up the outline and let's get started, David.
Okay, great, great. I'm going to go straight to our presentation, to my presentation here. So I'm going to share my screen. And let me get to there. Great. All right. So fantastic. So as I shared, this is Charitable Opportunities, which I subtitled The Secrets Your Advisors Never Tell You.
I love that
And,
title, by the way.
I think it's very accurate. You know, it really is. So, but we'll go from here. And let me see. Let me get that to click. There we go. All right. So I want to start out talking a little bit about, I think if you're going to be doing charitable giving, if you're going to be in any respect, whether it be through your estate or your lifetime, you need to know where your finances are. And that's something you need to really talk about with an advisor. One of the things that's good to know, though, is like your income tax bracket, right? Where's your federal income tax bracket? And so I am not a tax specialist. This is not my area, so I'm not going to go into depth on anything, but I wanted to present you with this table that just shows you if your salary is, if your income is within this range, then here's what your tax rate is for being in that range. And
so
that,
a charitable gift, let's say somebody, I'm going to use the 41,775.
okay.
So you make a $10,000 gift. That $10,000 gift comes from, is then reduces your adjusted income to 31,775. So it saves you 12%. I'm just using this as an example. This is not totally accurate. So Don, please don't give me the voice of God. Don is a CPA, so he knows more about this than we do. But anyway,
the answer, and you're the lawyer, I'm going to say it depends because
yeah,
of charitable contributions and where they fit.
Yeah, but you need to understand that you want to make a tax-wise gift. If you're going to make a gift, make sure that you take advantage of the opportunities to save money on taxes.
That's really right. And the thing to it is that taxes shouldn't be your motivation for giving, but you want to be wise in your giving. You want to be tax wise in your giving. And there's definitely, charitable organizations are a partner for you. And I'll talk about that too. All right. One other thing I'm going to point out just while we're on the screen is that when it says that, you're taxed at, 22%, and you can see that 22% for a single individual, they're earning somewhere between $41,775 and $89,075. So if they made $89,076, that doesn't mean that all of their money gets taxed at 24%, right? That's the next dollar level up. What it means is that it's indexed. So certain amount of your money is taxed at 10%, and then any money after that is taxed at 12%. Then your earnings after that are taxed at 22%, and then that last dollar that we added on that puts you into the 24%, only that $1 is taxed at 24%. I think a lot of people don't necessarily know or understand that. I had someone once tell me that they were going to turn down a raise from their employer because it was going to put them in the next tax bracket. And I went through and talked to them, and they accepted the raise. So.
Yes. Very good
right.
point, by the way. A lot of people don't understand that particular point.
Exactly.
Yeah.
Yeah, it was just a good notation.
Yes.
So this is what, and again, taxes, I'm not going to go into depth here, but I wanted you to see what our estate and gift taxes are in 2022. So you can see that for a single individual, there's an estate exemption of a little over $12 million. That means for a married couple, because it's per person, a married couple does not have a taxable estate until that value of the estate exceeds $24 million, right? Because there's two people getting a little more than $12 million a piece, right? However, this is tax laws change, and this one we know is going to change unless Congress votes to change to continue it, or however they do, because this sunsets on December the 31st of 2025, and then that $12 million is going to drop down to $5.4 million, about 5.5, well, yeah, about $5.5 million. So that's important. Anything over that right now, 12 million or 24 million for a couple, anything over that amount is taxed at 40%. So a high rate of taxation. And again, once that drops down from the 12 million to just 5.5 million, that's going to, a lot of people are going to want to reconsider and look at what they're doing, or, see whatever the tax laws are at the time. And I think that will be a driving force for the next sort of elections that are coming around, for federal level for certain. All right.
David, do we want to talk politics for about the next half hour? Or?
Definitely not. Definitely not. Not a chance. All right. Let's see. And then you can give away up to $16,000 to any person you want per year. So you
without having to file a gift tax return. You can give away more, but you just don't have to file an income tax gift tax return.
That's right. Because anything over $16,000 that you give away in a year, you need to file a form for. And what they do is they reduce that amount from your estate tax exemption for the future, right? So that's the reasoning for that. Why the IRS does that is that they are that the maximum amount you can give away in a year without to any one individual. So you can give away 16,000 to multiple individuals and you don't have to do any forms, but anything over $16,000 to any one individual, you need to make sure that you do your IRS forms, and then they're going to reduce that from your estate tax exemption in the future. Right along with that, long-term capital gains can be anywhere from 0, 15%, or 20%, depending upon your income level. When I talked to a CPA and I was asking her, but yeah, can you help me understand, like, because this isn't my area, can you help me understand, like the difference between what income you have to be at 15% versus 20%? She just said, David, all of my clients are 20%. So as far as I'm concerned, they're all 20%. So, so anyway, you'll want to talk with your advisor, find out where you fall in that regard.
But I think it's really important for people to understand what their cost basis is, so that, because when they sell, that's when the capital gains tax comes into play. And so understand cost basis is the important thing, because what we in the charitable field look for is low cost basis assets that have a high capital gain. So keep that in mind as we go through the program.
That is exactly right. So you want to remember what price you paid when you bought something originally. That was your cost. And then any growth that it's had beyond that is your capital gain that's associated with that. And that's what you're going to pay taxes on, is the difference between what you bought it for and what it's being taxed at. And that's what comes into charitable play and charitable benefits, is that you can avoid, and we'll talk about that here shortly.
Yeah. Additional taxes.
Additional taxes, yeah. So there's Medicare tax, and there's also California's taxation as well, which is as high as 13.3% for people that are making $1 million or above. For a married couple that filing jointly, that's almost $1.2 million, anything above that. So there's a lot of taxes to play coming into here. So that's important to know. And then I also just wanted to make note that, again, things change from time to time. Right now, we are still under the Secure Act that's setting every community up for Retirement Enhancement Act. The parts of elements of this that are kind of important from a charitable perspective is that if you are age 72 or older, you are required, you have a required minimum distribution from your IRA. And so that's important to keep in mind, as well as the other element that came into play with this is that it eliminated the stretch IRA. So you might remember that you used to be able to, if you passed away, you might leave your IRA to your children. And your children, you would tell them, if I'm going to pass away, and you're talking about your adult children, you're going to tell them, when I pass away, I want you to take that IRA and I want you to stretch it out over your lifetime. I don't want you to take all that money at once and pay all the taxes on that. Stretch it out over time. Enjoy the growth, the tax-free growth that it can offer during that time. Well, with the Secure Act, that element was eliminated doing the stretch, and so the stretch was limited to 10 years, and so your heirs have to take that entire inheritance within a 10-year period of time.
I'm just gonna I'm gonna pull a little punch in the sense of if you are interested still in the stretch, we're going to talk about this a little bit later, but a charitable remainder trust, keep that in mind as a potential alternative.
Exactly right, Pete, and that's what we're going to touch on. So
okay.
That's perfect. So we're going to get there, but that's why I wanted to bring it up here to be aware of. All right, now I wanted to note to you that that charitable organizations can be a great partner and creating partner solutions for you. They can help you, as I've listed out here, avoid capital gains, current, provide you with a current income tax deduction. They can help you to receive an income for life, which can be a kind of an interesting thing to wrap your head around, that you can make a charitable gift and can receive income. We're going to talk about that as well. They can help you to reduce a taxable estate if you do fall into one of those large estates that becomes taxable at 40%. They can help you to transfer wealth to your family, and charitable organizations can also provide future savings on income tax. And all of these are points that we're going to touch on. I want you to be aware and watching out for them. All right. So the first thing I want to talk about is a gift during your lifetime, right? So if you are if you're at least age 70 and a half and you have an IRA, you can make a gift from your IRA. Okay, now this goes back to the old rules that are still in place about being 70 and a half. You can make a gift up to $100,000 from your IRA to a charitable organization. Now, really, you really probably wouldn't want to do that until you're age 72 and you have a required minimum distribution. Right, so the laws just changed, and they didn't change the age on when you can, the earliest age you can do this at, but they did change the law as to when your required minimum distribution begins. And so it begins now at age 72 instead of the old age of 70 and a half.
I see Don popping up.
Don wants to share something. Share something, Don.
A question for you. You
Yes,
say
sir.
IRA. What if I have a 401k or a 403b or one of those other ones? Not so much with this, but in terms of Secure Act, did that stop a stretch on those also? Are those income in IRD, income in respect of decedent? I believe it's all of them together. Yeah. QCD is different. That's only an IRA, but I believe Secure Act was all of them.
I am not absolutely positive on that.
He's saying yes, so we can go with him.
I think that sounds right.
Okay.
Yes.
But I don't want to speak outside of my my area.
Pete doesn't mind doing that.
No, I don't mind doing that.
That's great. All right. So in regard to your IRA, this is that great opportunity to make a charitable gift from your IRA.
I usually the way I usually state it now, David, is that if you're 70 and a half and you donate to charity, tell me a reason why you're not making it from your IRA.
Well, I think if you're 72 or older, why
not do it at 70 and a half if you want to give it to a charity? You don't have to declare it in the income.
Oh, okay. Well, there you go. Yeah. So that makes a good point, right? Excellent point.
It's it's tax free. You don't ever declare it anyway. But 70 and a half or 72, both of them are good ages to give.
Absolutely right. Absolutely right. And one of the reasons for that is that, when you make that gift, if you make it directly from your IRA to the charitable organization, just like Pete was saying, you can have the check issued directly to the organization, and in doing so, you don't have to accept that as income. If you're not accepting it as income, then it doesn't add on to your taxes in the future, and you don't have to worry about taking a charitable tax deduction for it either, because you didn't have to pay a tax on it in the first place. So there's no charitable deduction because it went directly without taxation in the first place.
Don, you have in previous times had a couple of examples. Do you think you want to show that now, or do you want to?
I was going to ask, Don has a really nice slide on this, and that he and I were chatting about just before we started this session. So Don.
Okay, you can call me anything you want. You have to stop sharing.
Okay, you want me to stop sharing?
Or I'll knock you off.
All right. I have stopped sharing.
Thank you.
Okay.
Okay, so I'm going to share this.
Kind of a neat example.
Okay, so here's an example of a QCD. If for the sake of discussion, your required minimum distribution, at that point, you're 72. So Pete was talking about 70 and a half, but if you're 72 currently or older, you have to take out your required minimum distribution. For the sake of discussion, it was $25,000. If what you decided to do was to take 15,000 of that and give it straight to charity, then your taxable portion would only be 10,000. You would not pay tax on that portion because it's not there. You didn't come in as income. And if we said your tax rate was only 20%, which is fairly low, you would have just saved $3,000. And incidentally, your Medicare bill didn't go up because it doesn't show up as income. So that's important, but you're going, yeah, but I need the money to live on. Okay, here's a different example. If you gave to your church, let's say $50 a week, just for the sake of discussion, if you add all of that up, that's $2,600 a year that you would be paying to the church. If you take that out as part of your RMD and give the $2,600 to the church, you'd have to take out $3,250 because you're paying tax on all kinds of loads up. So if you did it as a QCD, you would save $650. Now, I had one person say, well, can I tell them to do this every week? My suggestion is go to your church and say, listen, I'm going to give you one check during the year for the whole amount. And they'll say, okay, thank you. And if you want to give the $650 to the charity, feel free to do it or keep it for yourself. But that's why QCDs are important. They do not come in as income. They do not affect your Medicare bill. They do not affect anything in terms of your charity. If I itemize or if I have standard deduction, which is sort of what Pete was alluding to when I was snarling at him earlier in terms of the $10,000, for standard deduction, it didn't help you unless you did it as a QCD. But now I want to ask a question since you've given me the microphone. Oh, wait, it's my microphone.
My God.
Is this all true also about an inherited IRA?
Yes, it is. Because an inherited IRA, you're going to have mandatory distributions, RMDs.
Right.
And so if you give that monies to a charitable organization, it doesn't have to come into you into your personal taxable estate.
And incidentally, you can only give up to $100,000 in a QCD. So if you have a really big RMD, you can only give that $100,000. Or if you want to start using up your IRA money to give to charity, which David would love to talk to you about, you can give $100,000 a year as a QCD, even though that's way over your required minimum distribution, because it's required minimum distribution. So you have the opportunity if you want. There was a lady we were chatting with the other day that how could she pass an inherited IRA to a charity? And we said, well, take it out as $100,000 a year as a QCD. So in their case, it worked out.
Yeah, QCD stands for Qualified Charitable
Distribution.
So yeah, we get into acronyms really easily in this field. And please remind us not to use them. So by the way, how do most people give to charity, David?
Most people write a check, and that is the least efficient way to give to charity.
Yeah. It's just.
And when I say write a check, I also mean, put in their credit card transaction online.
Yeah.
Anything that's an immediate.
95% of all gifts come from cash. The least efficient way to make a gift. Anyway, let's go back to your outline.
Yeah, I'm going to toss in one more thing on that. And that is that you can, when you call your plan administrator for your IRA, you can call them up and can say, I want you to make a check payable to whatever the charitable organization. I'm going to say Chapman University because I'm with Chapman University. So I want to make a check. I'm 72 or older. I want to make a check payable to Chapman University as a qualified charitable distribution, right? So a QCD, as we were saying. Also, this is also referred to as an IRA charitable rollover. So you're going to do a qualified charitable distribution to the charitable organization. And you say, I want you to write that check, make that check payable to Chapman University, but I want you to send it to my home address. And so then you at your home, you receive the check made to the charitable organization that you've selected, and then you can present that check to them yourself, right? So you can
mail it to them.
Action. Yeah, or you can mail it to them, however you like to do that.
Yeah.
Right? But that way you are part of the transaction and you didn't feel like you just told them to send a check and then you don't know if it got sent, you don't know if you kind of everything.
Yeah. And a lot of times what the brokerage firms do, they just put an account number on the check. And so the charity has no clue as to who gave it.
And make a photocopy of the check before you send it so that you have it for your tax advisor.
There you go. See,
Yeah,
that's a CPA. That's a CPA talk.
There you go. And by the way, that is when you have that check to share with your tax advisor, that is not to take a charitable deduction. That is to show that you fulfilled your required minimum distribution, or it applies to your required minimum distribution. So I want to make sure that that's clear.
Yeah. Let's go to the next slide.
Excellent. All right. So the next thing we're going to talk about here is another way that people, probably the most common way that people give after their lifetime is to give through their will or their living trust. And it's simply, a notation in their trust that,
You know what I love about this, David? It doesn't cost me a penny.
That's exactly right. That's exactly right.
I can feel good about naming a charity in my trust, and it doesn't cost me a dime. And it only comes into play upon my death. And my son is not going to miss 15% of my estate.
Right, exactly. So that's a really wonderful thing about donating through your will or your living trust, is that all your costs of, with your attorney were covered in what you were already doing with your family in the first place. And so in having the documents put together, it doesn't cost you anything today out of your pocket to give that money away in the future, beyond whatever your attorney fees were to draft the documents.
You put on the slide the value, and I focused in on that value, but I didn't focus in on the value of what you had put on there. And let me explain this. It is very difficult to pass on a value to your children via a will or a trust. It is written in legalese. It is dry. It's boring. The only thing it talks about is money. And the attorney is going to discourage you of including anything else in there. Well, I would have loved to have known what interested my father as far as what did he value, in the world. There are so many missions in charities, education, health, homelessness. You can just go on but this is a way to tell everybody, including your family in the world, what's important to you. And, as they say in politics, follow the money. And I think it's for us as individuals as well. If we really believe, and this is really of value to us, put some money behind it, put some time behind it, that this is important to you. Anyway, that's my lecture for today.
I think that's a great note. It really is important. It tells your family what your priorities are in this legal document. It tells them that, for instance, for myself, I've done in my own will and my living trust and in other beneficiary documents that I have gifts that are going to different higher education institutions because I believe in higher education. That's important to me. And within those, I also have, I've told that charity where I want my money to go, what I want it to do at that higher education institution.
Yeah. It says a lot about you.
Yeah, yeah, it
Yeah,
reflects values,
you know,
right? I think that's
Okay,
important.
let's go to the next slide.
All right, so here is one that I think is super important for people to think about. You know, if you're thinking that, you know, maybe you've already drafted your estate documents, you don't want to go make any changes because you're at a spot where you're happy, but you want to include a charitable organization, or maybe you haven't drafted your estate documents for whatever reason, but you decide that you'd like to include a charity in your estate plan, and you don't have a will or a living trust. What you can do is that you can look towards the things that you have that are separate from your estate in many respects in the way that they're treated. So for instance, you might have a bank account or some stock or some life insurance policies where you name a charity as a beneficiary, or you might, really the best thing to do is to look towards the assets that you have that are pre-tax. So those are IRD assets. You see I've noted down there in the bottom, that's income in respect of decedent. And those are those assets, when you leave them to your heirs, they're fully taxable. When you leave them to charity, they pass at 100% of the value to the charity without any taxation at all. So you might consider your IRA, as we were just talking about a little bit ago, or a percentage of your IRA. You might do, you know, your 401k, your 403b, or all the other different accounts that are out there for retirement accounts, savings and bonds, commercial annuities. Those are all fantastic assets for charitable giving, whether it be the entire asset or whether it be a percentage of those assets. These are really, and the other thing that's fantastic with doing a gift here is that there's no taxation involved, and there's also no fees involved, right? So there's no attorney involved, anything like that. It's just you go to your plan administrator, to your bank or wherever that is, and you say, I want to leave, you know, 20% to this charity, 10% to this charity, and the other 70% to my family. And you've specified in those documents, there was the beneficiary documents, and that's it. You're done. So it's an easy.
By the way, 90% of the public does it exactly the opposite. They leave the IRA and the 401k and the commercial annuity to the children, and then they include the charity in their living trust. Gosh, you know.
So David's going to let me show my slide.
Yeah.
Oh, really?
Yes, exactly to Pete's point.
Well, yeah, okay. We'll go. Well, let me share another slide and then let
okay.
That's all right.
You tell me, David.
Just tell Don to go away, you know.
Well, voice of God, give me just one.
Yeah.
All right. So what I want to show you here is a concept out of this, right? So this is a sample I put together just to show that, you know, somebody with a very large estate, right? A single individual with a large estate. So a $20 million estate. And it's showing you, I've got two columns here. One shows that if they had an IRA that were valued at $1 million and they wanted to give that IRA to charity. And the other shows that if they wanted to instead leave that to family without the charity involved at all, right? So I put together an illustration in concept here. I said that, you know, it's a $20 million estate. The cost of closing out the estate, I just said we're 2% of the value of the estate.
That's you're close.
Yeah. Okay. So it's in the range, right?
Yeah.
So it's concept. So here I've specified a bequest of an IRA that's going to go to a charity for $1 million. On the other side of that, you see the no charity part, that there's $0 there because they're not using a charity. There's no charity receiving the IRA. Then you can see that the taxable estate changes, the value of the taxable estate changes because you're able to reduce that $1 million out of the estate. So it wasn't part of it in the first place. Because it is a taxable estate, it's over the $12 million that for a single individual, there is still some asset of that that's taxable. And then the DSUEA, that is referring to that if you had a spouse that had predeceased you and you could carry over that, if you could carry over their $12 million exemption as well, In this case, the person is single that I'm using as an illustration, or at least didn't have any portability on that exemption, the state exemption.
So what the point of the slide is?
The point of the slide is, right, and now I had this gift, this $1 million, the individual is going to leave it to a grandchild. And that's why I've also added in this generation skipping tax.
Okay.
The big thing is to look down at the very bottom, and you can see that if they left this $20 million estate, if they gave $1 million to charity, it would be about $16 million that would go to the family. If they didn't leave that $1 million that was going to to family, if they instead left it to the grandchild, so they had to pay the tax on there, it's $16.2 million is what ends up going to the family. So it only costs, a very small amount to be able to do something charitable in this example. And I'm using a high example,
but that's
hadn't been going.
But that's the value of having the Crescendo software,
Right.
And it doesn't have to be 20 million, it could be 100,000. The cost out of pocket, the number is out of pocket can be immensely smaller, and even it could be potentially greater. So even if you don't have a philanthropic bone in your body, sometimes these charitable plans really work out for you. Don, you want to come in and say something?
Don, you're going to share a slide, so I'm going to stop sharing here.
Smile, Don. There you go. It's hard to make a CPA smile,
Frown easy. Okay, so see, David's much more analytic than I am. I'm really simple-minded. So here's my example. I have an estate of $2.5 million, an IRA of 1.5, and a house of $1 million. The kids, of course, say, we want the IRA because it's a heck of a lot bigger. So you can have the IRA at $1.5 million. When you pay maximum capital U.S. tax, federal tax, California tax, the kids net about half of that.
You're talking income taxes, right?
Income tax, I'm sorry, yes, because it's fully taxable.
Yeah.
The house goes to charity for $1 million. Wait a minute. What happened to this thing? This thing doesn't make sense. Well, here's the answer to the question. The question is, give the charity $1.5 million, and David will applaud you and think that you're an absolutely wonderful person. Give the kids the house. At the present time, you have step up in basis, which means it gets revalued at $1 million. They pay no tax, and they have the house, which they can sell with no capital gains tax for $1 million. Win-win. The charity gets more money, the kids get more money. Because if you gave the kids the IRA, they get the heck taxed out of them. And you can say, stretch it out to 10 years and be good kids, or they can buy the Maserati tomorrow and pay tax on it the following day. But you can control it. If they get the house and sell it, they could still do that. On the other hand, they'll get more money because step up basis brings the house up to current value. No capital gains tax.
Yeah.
And the charity is really happy with you for the 50% more. So
Don, I love this slide.
I'm simple-minded in the way I do pictures.
No, I think this is excellent because most people think that IRA monies and monies outside of an IRA are the same.
Yeah, no.
And they're completely different.
Right. Okay. Thank you, David.
All right. So I think that's really key, and that's important to understand which assets are the best assets to leave to charity. And that was the real point of what we're trying to do.
People are reluctant to share. What if I came to you, David, and I share what I have? Aren't you going to take advantage of me?
If you're talking to the charitable organization?
Yeah.
My goodness, no. We're here to be of service and to help you out in understanding things. It can feel, you want to talk with someone you trust and you understand, right? So you probably don't want to, you want to build a relationship with a charitable organization before you have some of these conversations all the time, right?
But I guess the point I'm trying to make is that it's difficult for people to share their assets or what they have.
Well, because we're taught in our culture that we don't talk about our money publicly.
We don't talk about our money. Yeah.
There are other places that do, they talk very openly.
Yeah, not here. I think if we get together over Thanksgiving or Christmas and as a family, the last thing we talk about is money. We just don't talk about that. And because we're worried that it might offend or somebody is going to take advantage of us. And money is a very secretive topic.
Yeah, and so, you know, it's one of those things where having an advisor you trust is really important, and having a charity that you trust is important for an option there.
Yeah. Make a gift, get income. How does it work?
Yeah. So this gift, this is what's called a charitable gift annuity. And this is one of those mind-blowing things that I mentioned that a lot of people don't know. You can make a charitable gift to charity. You don't have any attorneys or anybody involved in the whole process, and they're going to give you back money for the rest of your life. And with this, what's called a charitable gift annuity. And I'm going to show you some examples here, but you actually get a rate that's based upon the age that you're giving. You're going to get an immediate tax deduction, not for the full amount that you're giving to charity, because you're going to get money back from that, but you're going to get a tax deduction up front. You're going to get an income stream that's for your lifetime. So not just a period of years, you're going to be, no matter how long you live. And then a portion of that income that you're receiving is tax exempt too. So it's a really fantastic option. So let's talk about gift annuity rates. So charitable gift annuity rates, these are the current rates. Now they're going to change this year. We've already been told that they're going to change on July 1, 2022, and they're going to move up a little higher. So if you are thinking about exploring one of these, you might want to wait until July 1 to set one up so you can get the higher rate, but you might also be incentivized to do it now, whatever your motivations are. But so this is to show you what the rates are for an individual. So you can look, and I've highlighted different ages here, just going through, but 60, 70, 80, and 90, you can see the big leaps of changes on what the rate that you receive on the income that you're going to receive from that charitable gift annuity.
David, do you receive a commission, or does a charity receive a commission when they do a charitable gift annuity?
There are no commissions involved at all for the gift officer or anything along those lines when you're working with charitable gifts. It just doesn't happen. It's not allowed. It's considered unethical to have any sort of commission or anything like that. However, your financial advisor might be trying to sell you an annuity, not a charitable gift annuity, but an annuity.
Commercial annuity.
Commercial annuity. And that is a very different beast.
Yeah.
Pete, you might have some commentary on that. Do you?
Yeah, it's just commercial annuities are not simple agreements. So, and you could turn a commercial annuity into a charitable gift annuity at some time as well. They're completely different products whatsoever. They're not similar. You don't get an income tax deduction when you do a commercial annuity. These rates are not established on a commercial annuity. So, but whenever you do an annuity, you're doing an irrevocable gift. And so you need to consider it carefully when you do. So, but the rates, I look at these rates. I mean, are CDs paying 6.5%, or even at 70, you can't get a CD at close to 5%. The rates are fantastic.
Yeah, the rates are really fabulous. They are, and I'm going to show you some examples on here and how.
Yeah, we had a lady who died. Not the lady who died. Her husband died, and the pension plan died with him, and so she had a Berkshire stock, and she turned it into a gift annuity, and that income allowed her to live comfortably for the rest of her life.
Oh, that's fantastic.
But David, what happens if Chapman University goes broke and has no money, nothing else? What happens to my annuity?
Yeah, so if you have a charitable gift annuity with a charitable organization, which is the way that that's done, and that charity has an issue and they close down for any issue, they close down. You were at the very front of the what's the word I'm looking for? Creditor. Thank you. It just escaped me for that moment.
Yeah.
But important. And also, when you set up a charitable gift annuity, they're highly regulated, particularly in the state of California.
The money is set aside in a special fund.
The money's set aside. So the charity has not spent your money. They've actually put it aside, and it's sitting there and growing in an account. And there's some money that's in special reserves that are even more, they're more conservative in the way that those funds are invested. And so it's really meant to I can't use the word guarantee because that's not inaccurate, but it's really meant to secure as closely as possible that your gift annuity is a secure income stream for you for the future.
And there's all kinds of requirements through the insurance commissioner.
Yeah, I don't know of one gift annuitant that has never received their money.
So the important part of this is, number one, you want to go with a good, reputable charity.
Yes.
Number one, it's not Billy Bob's Boats and Bait Shop. No offense to Billy Bob. Two, if a charity is offering a charitable gift annuity, there's a lot of regulations that they've had to go through, but be very careful in terms of doing it. But if I set up a charitable gift annuity with you, David, and then 4 years from now, I get mad at you and decide I don't want you to do it, can I transfer that to another charity?
You cannot. You have limited where it's going.
Yeah. It's fixed. Now, of course, it's what, a 30-page document I have to review?
No, it's about a 2-page document.
Yeah, right.
Let's go to the next slide, David.
All right. You know what? Before we slide on, I want to just mention that if it's two people, if it's a married couple, the rates are different based upon their ages. So it looks at their combined ages and uses a slightly different rate chart based upon those ages.
Yeah.
It's going to be a little lower. I want you to know that. But
it usually lasts longer.
Yeah, they last longer. Importantly, you can set up a gift annuity that, we'll touch on this, so that's okay.
Yeah, you can set up gift annuities for friends, family members.
Yep. Yeah, I'm going to touch on that too. I've got a slide on that. So let me just hit this one real quickly. And this is just an example. Most charities have a minimum gift amount. Matter of fact, all charities, I think, have a minimum gift amount for charitable gift annuity. At Chapman University, it's $10,000. Some nonprofit organizations, it's $5,000, and some it's $25,000 or maybe even higher. But at Chapman, we do $10,000 as our minimum. I'm going to use that as an example here to show you, because it's easy. If you're thinking 100,000, you just times it by 10, and it's just easy for math purposes. So let's say you have this cash. In this case, I'm using a cash of $10,000. You gift that to the charity. The charity is going to set up a charitable gift annuity for you. And you're going to get, in this case, this individual, these two married couple, their age is 72 each. You'll see up in the top right-hand corner, Larry and Laura. So they're both age 72. So they get a tax deduction of $4.3 thousand, and that might save them about $1,621 right there. Then you'll take a look at that middle slide here. The charity is going to take that $1,000, and they're going to invest that, and they're going to give you as the donor, or they're going to give Larry and Laura back a 4.3% annuity based on their ages. So if they were older, it would have been a much higher rate, but at their ages, it's 4.3. They're going to get that. They're going to get $430 back every single year for the remainder of their lifetime. And out of that, $297 of that comes to them every year is going to be tax-free money. And so if they live their expected life expectancy, right? And a lot of people in Southern California live longer than their expected life expectancy in the first place. But if they do, they're going to be expected to get a payout back for themselves of a little more than $10,000, so more than they even gave. And plus they got that charitable deduction. So that effectively, when you look at all of this from a tax perspective for this couple, they're effectively getting a 7.2% return, not 4.3, but they're effectively getting a rate of as if they were getting a 7.2% because of all the tax benefits that come into play here. And that's important to know. Then whatever remains after that individual's lifetime or that couple's lifetime then passes to the charity. I like to show that, we anticipate when someone sets up a charitable gift annuity that ultimately the charity gets about 50% of the value. So I showed on here an example of just showing $5,000 as the remainder that goes to the charitable organization.
Yeah.
And so, but it passes along right away immediately following the death. And that's just a wonderful way to do something and get money in return. There's something, yeah.
I'm going to interrupt you just for a second, David, like I normally do.
Like you normally do, right? Exactly.
A friend of mine got a bonus from a $100,000 bonus because he was an executive in a firm. And what he did was he used that $100,000 as the bonus, and he gave a annuity in his mother's name. And his mother at the time was 90 years old. So at 90, if I remember the chart, it's about an 8% annual income. And being 90, he received almost a substantial income tax deduction. So he made a gift to his mother. He gave a gift to charity, and he got an outstanding deduction. So his actual gift to his mother was actually very nominal. It was a wonderful way to use a charitable gift annuity. Anyway, I just wanted to pop that in.
That's right. And at age 90, that's an 8.6%.
And that's just the rate. That's not even counting the deduction.
Yeah.
He got the deduction.
Yeah.
Yeah.
Really spectacular. Really amazing what you can do. So I want you to know that there's different things you can do with gift annuities. You can set up an immediate gift annuity, which is what we've been talking about here. You can set it up for the income beneficiary to be your mother, such as Pete was giving our example. You can set up what's called a deferred gift annuity. And a deferred gift annuity means that you don't really want to take the income yet. Like, let's say you're age 60 and you really want to wait until you're age 75 to start, that you need to start taking income, you think, for the future. So you give the money to the charity. You say, you don't need to start paying me until I reach age 75. And because you do that, you actually get a higher payout rate back to you as a result of that. And the other thing you can do, and this is a really, I think, important one to keep in mind, and that is that you can do what's called a testamentary annuity. You can leave the money to charity. You can tell that charity that when you receive these funds after my lifetime, I want you to set up a trust, or I want you to set up a charitable gift annuity that's going to benefit this person that I love. And I want them to receive a check every year on my birthday to remind them about, who gave them this gift, or maybe it's, for your kids, so that when your kids, you give it to them a month before Christmas, for instance, if you celebrate Christmas, to give them a moment to give them a little extra funds to help their kids. Any of those types of things are great. So that can be a really nice alternative. So I want you to know about those.
And it's very simple. Just so simple.
Exactly right. Okay, we're going to talk a little bit about a charitable remainder trust.
A little bit more complex.
Yeah, this is more complex. This involves an attorney. This is a great way to avoid capital gains, or to defer capital gains, we should really say here. So the attorney drafts up an agreement for you. You can put stock or cash or some other asset into this unit trust that's created, this charitable trust that's created. And you get to actually determine your own income that's going to be paid out to you. You get to determine what your payout rate is. It just has to make sense in the numbers, and that's where you need somebody that's running, the charitable software, are your financial advisor to be able to run these numbers for you, your CPA, usually working in partnership with a charity, because again, a lot of times they don't know enough about these types of options. So this is where you really want to come in and bring in a charitable organization to help have this conversation with the advisor.
Yeah, what I see, David, is people using the charitable remainder trust when they have a highly appreciated asset with a low basis, i.e., they were renting a house out and they've been doing that for 30 years, and the property value has increased immensely, yet their cost basis is really low because they've taken the depreciation on that. And if they were to sell it outright during their lifetime, they would have to pay an awesome tax on it. But using the charitable remainder trust to sell it, it saved them a ton of money.
Big time, big time.
Yeah.
In fact, we just had one of these back in December, where someone had bought a property and they had used as a rental property. They actually had several little apartments in on oceanfront, and it ended up, they bought it for, I don't know I can't recall what the dollar amount was, but
Yeah.
they did it back in the early 1960s, and so they sold it now. It sold for, I think, $3.8 million, but they sold it within the charitable trust, so there wasn't the taxation on that. Otherwise, it was all capital gain.
And I don't see people running the numbers before they decide to sell. And it's not like you have to give 100% of the property. You can give a small percentage of the property. There's all sorts of ways that you can get creative, but this is cocktail talk. And what I mean by cocktail talk is spread the word that run the numbers before you sell a highly appreciated asset. Take a look at a charitable remainder trust, because again, most professionals out there are not familiar with this.
That is exactly right. Thank you, Pete. And I'm going to point out again, just on my slides, anytime that you see where it says Chapman and it shows a gift box, Chapman, I work at Chapman, which is a nonprofit organization, so I always use Chapman as an example. It's any qualified charitable organization. So keep that in mind when you see that.
By the way, I just wanted to make a quick point because there was a question in there. I said, if you need the monies during your lifetime, upon death, yes, you get a step up in basis, but during life, you don't. And by the way, when you have assets, you want to use them during your lifetime. You've saved money. So give me an example, quick example. A friend here in Laguna Beach had 3 rental properties. He put 2 of the rental properties into a charitable trust. It allowed he and his wife to spend the next 10 years traveling around the world because they didn't have to manage those properties, and the income flow was greater than the rental. And they left their one house to the children, but they enjoyed. The reason why they did it was because they were tired of tenants and toilets. So anyway, back to your slide.
All right. So I'm going to pop back over here. This is the next slide. This is just an illustration, and really this goes along lines of what I was sharing about the individual that I mentioned did a big gift in a big charitable remainder trust earlier this year, or right at the end of last year. And so this person has a property valued at $1 million that they bought for $200,000. So they've had a capital gain of $800,000. There's going to be a lot of taxation going on that gain, right? So they set up, in this case, I just used this Larry and Sally sample up here, ages 61 and 55 in that top right-hand corner. They decided to set up a charitable remainder trust, and so they put those funds into this charitable trust, and I think my numbers that I used in my example, they're not showing. Oh, I didn't show the, this is a non-taxable estate is I think what the scoop is on this one. That's why the numbers are coming in low on some of the taxation here. Anyway, point being is that they take that $1 million and they're going to get out of that, because they're getting a 5% payout. Every year they're going to get $50,000. And previously they were only getting a 3% return on this property that they had. So they actually boosted their income by an additional $20,000. If they live the expected life expectancy for this couple ages 61 and 55, they should receive 2.1, almost 2.2 million dollars in income from this charitable remainder trust over their lifetime. And then then after their lifetime, whatever remains is going to go to the nonprofit organization, in this case Chapman University, and we've estimated with the return rate that we were putting on here that the charity would receive 1.3, almost $1.4 million. So this is an example. I'm going to replace the slide with a better slide for the future. But
by the way, Don, come on back.
I'm going to come back
and stop sharing for a second.
Okay.
Why? No, he doesn't. Oh, okay. Yes.
Yeah.
Oh, yeah. I would
So
actually
I
like
can see your
Don to
face.
share.
Because Don is a philanthropist, and so you did a charitable remainder trust.
I did.
Are you now in control of that monies, or is it, how do you feel about that?
Geez, if I say I'm really happy, then am I owing you something for having recommended it and for David having run the numbers for me? So in our case, we had an office building and had a significant capital gain. Pete says it's wonderful. I don't think it's wonderful. I think it's a horrible tax that you have to pay if it's your tax. And so by doing a charitable remainder trust, we put the building into the trust first, then we sold it out of the trust from where it was. The money that resulted from that is invested, and my wife and I are the trustees of the trust. We're responsible we've hired an advisor to manage the money for us, but we have complete control over that. We specified in our particular case that there would be certain charities would get a certain amount, and 50% of the money, so half of it went to the various charities, and half of it we set up a donor advised fund, which our children will manage after we pass away. Now, during our lifetimes, we can change any of those. If we get mad at our kids, you take the donor advised away from them. We have changed charities along the way because of certain issues that we felt were going on with the charities. So we had complete control of it. And so we're responsible for that, and we manage it. We could hire a trustee to do it for us, but to me, it's real simple to do.
And what about the income?
And so the income stream, in our case, and I don't remember the slide sequence you've got, David, in our case, a charitable remainder trust, we have, so on December 31st, we value the trust, and we get a fixed percentage of that on an annual basis. Given what the stock market's done, the trust has gone up in value, not down, although we take out a nice amount of money from it. And so every quarter we get 1/4 of that money as it goes along. So right now with the stock market going berserk, Pete and I were talking about this before we went live. I don't care, because we get the same amount of money for the year. It doesn't change during the year. Now, it bothers me that it's down, because next December 31st, I certainly hope it's back up, because that affects my next year as turns we go. And I wanted to add one, incidentally, that Pete had done. And Pete loves it when I say this. Last century, Pete helped a couple set up a trust. It was 1996, so it truly was last century, proving how old Pete is. They set up a trust that during their life, they would get, I believe it was 8% out of the trust. When they passed away, their heirs, the people they want, family members happen to be there, would get it during their lifetime. I'm sorry, not during their lifetime, for an additional 15 years. Because a lot of people will look at a charitable remainder trust and say, my kids will kill me if I give away the money. Well, in this case, during their lifetime, they took out this much money. During the kid's lifetime, it took out this much money. And at the end, the money went to charity. The money given out at the end matched what they put in at the beginning, and they took out 8% that entire time. And the kids were very happy with the money. Yep, here's what they got over the time. And they set up the rules. The couple set up those rules when they finished, when they started, and when it finished, The remainder went then to charities, which is how we got involved with it. But Pete did that last century. Big note there. Okay. Sorry,
But
Pete.
the charities received the monies this,
Yes, they
this
did.
last year.
Last August, it cleared, and
But
that's why
it's
we got
hard,
involved with it.
but it's hard to wrap your head around that you're giving money away, and yet there's a lot of money that goes to the children if that's what you want. So and each one of these circumstances is very individual, and that's why it's important to work with somebody like a David or a Don, so they can run the numbers to make sure that your objective is met. And that's the key.
And a key question that just came up incidentally was, at a point that I had made earlier, we put the building into the trust, then we sold it. If you sell it and put the money in, capital gains, you're toast. Yeah. You can't, no, don't do that. It has to go in first. In fact, in our case, we were just about to sign the contract with the realtor when I'm chatting with Pete, and suddenly went, stop, let's see what happens. Okay. And we still controlled the sale. I mean, we're the trustees. We ran, how much do you want to take from the trust? How much do you want to, will you accept this offer? Whatever. We were in complete control of it. So all of that was there.
You mentioned that you did 50% to a donor advised fund, but I think, David, you're going to have a slide on the donor advised fund.
I'm going to talk about donor advised funds.
Okay, we have about, how much time do we have left?
I think we've got about 9 minutes left at most.
Okay,
I'll be quiet.
So, all righty, let's go, Don.
And Pete will be quiet.
All right.
That's impossible.
I'm going to go back to sharing my slide again, and we are going to get to that question. And just for that other question a moment ago, when they were talking about selling it within the trust, they're talking about selling the property within the trust, right? So it's not selling the trust, but it's selling the property within the trust.
And you don't have to do 100% of the property. You could do 50% of the property.
Yeah, there's variations. These are all things you want to explore and get to understand better. This is an example of what's called a charitable lead trust. And this is something that these are usually done when there's, the family has a lot of money, and so they want to leave money to the family, and in this case, this example, they want to minimize any sort of estate tax that might come in. So in this case, with the charitable lead trust, what happens is that this is a way to increase wealth for your heirs.
Just to let you know, my screen just went crazy. I don't know if it's happening to others, but I'm going to sign off and sign back in.
Okay, got you, Pete. So
we'll save time. And yes, Pete, it's you, not the system, because I'm looking at everybody else.
Okay.
So in this case, what a charitable lead trust does for you is it allows you to have a property, and you place that into a charitable lead trust. And what happens is that you're going to provide an income stream. It works exactly the opposite of the charitable remainder trust. So instead of providing an income stream to you, and then after your lifetime, the remainder goes to the charity. Instead, it provides an income stream to you or to your other benefit. It provides an income stream to the charity for a period of years. So that might be 5, 10, 20 years, whatever period of time someone chooses. It provides an income stream to the charity, and then that property, whatever growth it's had, whatever value that it's managed to increase over that period of time, so let's say 20 years, that property can then pass to the family without any taxation. That is a remarkable thing called a charitable lead trust. So I'm going to show you an example of that, but it's exactly the opposite of the charitable remainder trust. So in this example, they had a $3 million property that they originally paid $1 million for. They had $2 million in gain. They place it into a charitable lead trust with a 5% payout, because that's the rate that they chose for that. And they decide that they want to do it over a term of 20 years. That means over a term of 20 years, they will have given a charitable organization $150,000 a year for a total of $3 million over that 20-year period. In the meantime, that property which again, they originally paid $1 million for, has now grown in value with the example that I'm giving here, which is a very conservative example, but that's showing that the value of that property has grown to $4.1 million. That $4.1 million in growth can go to the family without any taxation at all at that point, because of the way that they did this gift, where it all worked through the charity. So that's an example of a charitable lead trust. There's lots of different ways to do these and lots of options. I want to mention just a couple of things that I think are really some smart giving options if you are charitably inclined in the first place. So for instance, if you are planning to, leave your home to charity, maybe you want to, for whatever reason, you have a property and maybe it's and let's say it's your home that you're living in, you want to leave that to charity after your lifetime, you can actually choose to leave it to charity during your lifetime through what's called a retained life estate. So you actually give it to the charity, you sign a contract with the charity that says you're going to continue to live in it, you get a tax deduction right away. And then your tax deduction, if you weren't able to use it all in 1 year, it can carry forward up to 5 additional years on top of that. And some charitable organizations will even issue you an annuity. They will actually pay you to live in your home. So this can be a remarkable thing, a retained life estate. So if you're charitably inclined, you're going to leave your home to a charity, you might consider doing it during your lifetime in the first place. And then all those types of things get worked out. It's something to explore. Another thing to explore is the idea of a bargain sale. Let's say you have a property that's located right next to a charitable organization, and you think it would be a great item for them to be able to expand out and do some more growth on, but you don't want to give it away in the same way. You don't feel like you can afford to give it away. Well, you might choose to do what's called a bargain sale. And that's where you sell it to the charity at a greatly reduced rate, right? So maybe you sell it for 30% of its value. It's not just a 5% discount, right? But if it's a big discount, like let's say 50% or 30% of what it's valued at now, you can actually give it to charity, and the charity pays you for the 30% value, and you take that 70% value as a charitable deduction, right? Because all that growth that it's had, you get to take that as a charitable deduction. So that is also fabulous, something to look into. Right along with that, just other smart giving options. Somebody asked a question in the Q&A a moment ago about donor advised funds. Donor advised funds can be a great way to give. They are a way that if you don't know what charity you want to give to yet, you can just put money into an account, and you can and this donor advised fund. So it's basically, it's like having your own little private foundation. And this shows that that there are now you can set it up, a donor advised fund, for as little as $5,000. I actually think that there are now newly out in 2021. I think there's some donor advised funds that don't even require a $5,000 minimum.
Schwab was 2,500.
The Schwab is 2,500. Yeah, that's remarkable, right? So you can make your gift to the donor advised fund, and that's where you get your charitable tax deduction. And then you can choose to issue money from that. You don't get deductions in the future, but you can advise your fund, and you can say, I'd like for you to make a gift to this organization. As long as that organization checks out and there's no issues with it, the donor advised fund is going to, the manager of that asset is usually going to follow your wishes. And so a donor advised fund can be very helpful. It's a great way that, if for you wanted to make a major gift to a charity, and maybe you didn't know what charity that was, and you just wanted to set aside $10,000 a year until you reached $50,000, and then you wanted to make a big gift of $50,000, well, you could get a tax deduction every year for your $10,000 as you put it into your donor advised fund. And then at the end, you tell that charity, I'm going to issue you a $50,000 gift, and you get the accolades, you get your name on the wall, or whatever it is that might be something that was important to you. Maybe recognition isn't important to you. Those are all things that you can talk about with the charity. So that can be a great way. Matter of fact, even when you pass away, you can decide that the assets that are in that donor advised fund are going to go to a charity, or you can instead have it, your family has the right to make the distributions in the future. Wrapping up here, I just want to say that, think about all these things that we've been talking about that are about gifts that are after your lifetime. It's really your lasting legacy. And so, talk with a nonprofit organization about your plan, see if they can bring in some expertise and help you. You don't have to you're not obligated to do anything here. You can just have the conversation with them. You can ask them about recognition opportunities if that's something you'd like to explore. You could talk with them about, if they're going to use those funds immediately, if they're going to set them up for an endowment, a permanent fund that's going to have your name on it, will perpetually support that charitable organization. So really, as I wrap here, I just want to say, your call to action here is to consider your own legacy, what's important to you. If you are leaving a gift to a nonprofit, I believe it's important to tell the nonprofit. I think it's
almost a second gift,
Yeah. It's if you allow that nonprofit to share that your story, or put your name on the donor wall, and one of your friends walk through and they go, oh my gosh, David Moore has an estate gift with this charity. Gosh, I didn't know that. And I know David, and I'm going to ask him about it and understand it more. I mean, these are important things that you can inspire. So it's a gift beyond. You always want to consult with a trusted advisor. It's really important, and a qualified advisor, someone that can talk with you about taxes, someone that understands your unique financial situation.
David, next slide.
Can help beyond that. Last thing here is I just want you to know that if I can help you in any way, I'm glad to. Here's my contact information and a little bit more about me. And thanks so much for letting me share.
Good photo, David, and thank you for the wonderful presentation. Let's come on board and
Good.
we did it.
Bonnie
Hi,
decided
Bonnie.
not to be on a phone call at 11.
Why don't you unmute yourself, Bonnie? And I want to thank you for that sponsorship for the series. It's been wonderful. Bonnie, again, estate planning attorney with the American Heart Association. David is with Chapman University. Don is with Financial and Estate Literacy. And I'm just a talker.
Okay, so I'm going to wrap it
Thanks,
up.
Peter.
So this has been Financial Estate Literacy. This has been It's Your Estate, week 5, which is Charitable Giving Opportunities. We thank you all for being here. Next week is the 6th week, which in the new version is the last week, and we will have Pete and Trevor talking about estate administration, which is something that's going to be, drink some caffeine before you get here because they're so bland in terms of things that they say. Anyway, thank you very much for being here. Thank you all for sharing. Have a good time. Bye.
Thanks.
Bye.
Bye-bye.